Hey, Dustin Tibbetts here, financial advisor with Jazz Wealth Managers. I hope you'll check us out, jazzwealth.com. We are financial advisors for every size investor. We'll help you with everything along the way. And one of those things that I want to talk about today is for my younger investors. Where are you at, right? If you're young, you're thinking about investing, or you're already starting investing, I want to make sure you don't make these 4 mistakes here because I see them every day. I help people tweak and adjust every single day. So we're going to dive into this one here. Number 1, the first thing that people make mistakes at, 20s, 30s, early on investors here as you're just getting started, is you get focused on the dividend stocks. I'm not against dividend stocks by any means. We have a dividend growth portfolio on our website there. It does well. I really like that fund. The issue is if you go all in on dividend stocks, you end up sacrificing what could be better growth in the future. And I want to explain that to you by showing you a chart here real quick. So what I did is real quick, I put in, let's go like this to make it bigger. There you go. So what I did is I made just a real simple mix. We call it simple dividend mix here. I took 3 dividend-based ETFs just randomly. I didn't put a whole lot of thought into this here. We went with the REIT ETF. A lot of people like to use. We went with the S&P dividend ETF, and we went with the Vanguard dividend ETF just because a lot of people like to use Vanguard products. And we said let's just basically split it evenly across the board. So that's a fair mix, a simple portfolio mix. When we look at that portfolio mix, expense ratio 0.25%. It's basically all in stocks. The rest of it's in cash. Average returns don't seem too bad there if we're looking back. So all in all, pretty happy with that. Let's take a look. If we compare it to just anything growth, now my favorite sort of growth mutual fund is the T. Rowe Price Blue Chip Fund. So I just compared it to that. You can compare it to anything. You'll find that it's basically, just a little bit sort of behind everything. Take a look. At the end of, looking back throughout the whole lifespan of this mix here, goes back over 10 years, you find that if you use the purple mix, which is the dividend mix, or any mix of dividend funds there, you end up with about $28,000. You use a growth fund, you end up with about $40,000, right? So that's just to show you the comparison. Now, one thing I want you to notice is the recession that I've highlighted here in gray. This is that great recession that we went through. Did you have any more advantage by being in a dividend fund versus being aggressive? No. They all lost the same. Everything was basically identical through the recession. You had no real advantage. So a lot of people say, well, if we're going into a recession, I want to be in some dividend stocks there. Didn't really make a difference, right? And that's just one recession, of course, but didn't really make a difference. The key is that growth stocks, growth funds, things like that, when the markets get going and they start moving and moving and moving, they turn into like a snowball, an avalanche that builds bigger and bigger and bigger, while dividend stocks are pretty much consistent. They don't build on top of each other. That's a big distinction there, so I want you to check that out. Anyways, we got about $39,000 compared to about $29,000 there at the end. And so what we did is we said, okay, look, I just said, I picked the T. Rowe Price, the growth fund there, just because I was interested in it, and I was quick to put up on the chart for us here. So I went back in there and found an extra one there. I found a Vanguard growth ETF, just because people say, oh, Vanguard, you got to have Vanguard, or it's no good if it's not Vanguard. So I put a Vanguard growth fund in there, and that's the orange one now in this case here. So you can see the dividend mix, right? Not a bad return. I can't knock that return at all. It's just less than the Vanguard growth fund, less than the T. Rowe Price growth fund. So if you're young and you're supposed to be investing for growth, don't go too heavy on those dividends, right? You don't want to go too heavy just yet. If you do, you miss out on those returns there that they're not a big deal, right? After 10 years, if you were to invest in that T. Rowe Price fund and then go to dividends versus invest in a dividend mix and then go for straight dividends, if you yielded 4% a year, let's just do it. I'll just show the chart. I got this thing here. So at the end of 10 years, right? Let's say you say, I'm going to do the growth fund thing for 10 years, right? And then I'm going to do the dividend thing after 10 years. So I've got my dividend mix, and then after that, I'm going to go all in dividends. That's just my goal. That's what I want to knock out. That's how I'm going to do it. If you waited after 10 years and you went to go put either the $28,000 or the near $40,000 from that growth fund, now go into a dividend, you've got $133 a month passive income, just a real simple raw math, and you got $93 a month in passive income over here. It's not a huge difference. It's 40 bucks, right? Like it or not, it's a $40 difference, but every penny counts. How efficient can you be with your investments? We may be going into a really rough time here economically, and if that's the case, how efficient are you with your investments? Make sure you get the most out of them. Don't just do what you read in a book or someone suggested along the way. It makes it sort of tough there. All right, tip number 2. You got to invest aggressively enough. It sort of leads it back to tip number 1 there, but make sure you're investing aggressive enough for your age. Now, it's going to take a little getting used to, because if you're new to investing right now, or over the last year even, you've seen the markets wiggle around so much, it's a little scary. I'm going to be honest, if I was brand new, I'd be a little bit nervous myself here. So I want you to just make sure you invested aggressively enough. I did a video here last week on, I don't know if I shared the name, so I'm not going to say the name there, where we looked at a 401k, and this was the current 401k mix that this person had. And so we looked at that and said, okay, can we be more efficient? Can we be more aggressive without really messing anything up? So we went through everything and found that we could be more efficient, simplify the overall allocation, keep him more aggressive, and when we compare that, over time here, he ended up with a much better return. The purple, of course, is the suggestions that we made for him. The gold down there at the bottom, that's the funds that he was in. And so by not investing aggressive enough, he's missing out on a difference of about 2.5%, over 2.5% average returns there. So we ran that and said, well, what if this was his scenario? What if he had $20,000 as his starting balance and he did $1,000 a year for the next 25 years? We put in inflation. He invested $45,000 total, never raises his contribution. His current 401k, which he thought was aggressive, by the way, would have ended at $209,304. Our suggested 401k, assuming everything continued, would be $435,000, difference of $226. Now, even if those numbers are a little off or way off, it's still an improvement, right? So make sure you're investing aggressively enough. You may go back last week and check that out. There's a video we did about the 401k investments there. I want you to make sure you're investing aggressively enough. Get help. It doesn't have to be with me. I get it. This is marketing, right? You keep me in mind. But go find somebody to make sure that whatever you have, can it be improved upon? Can it be more aggressive? Things like that. All right, number 3, the third tip I want to give you there is not being small and consistent. This goes against everything that every advisor ever tells you. They tell you just put money in, go ahead, start investing, don't worry, we got you covered, start investing. That's not the answer. Someone tells you to do that, you go, well, okay, you didn't say anything about what you were going to do with the money. I need people to be more specific, right? What I want you to do is I want you to take the amount that you have to save for retirement. I want you to divide it up over the months, right? Then you got to decide, can you hit that goal? If not, go tweak your goal. Don't stress about the number, right? So if you have this number you got to hit, and you can't make that in a monthly contribution or deposit to your account, then go tweak your goal first. Once you have it broken down in a monthly, I want you to break it down over the weeks. I'd rather you do a smaller amount every week, especially in this market, whipping around back and forth and everything. If you make the smaller deposit every week versus the larger monthly deposit, number 1, it's easier on your brain, right? Like you just a smaller amount, you don't think as much of it, it's a little bit easier. Number 2, when the markets blip down, you might have a deposit going in at that time that gets bought at a discount. When the markets go back up, that's fine. Yeah, everything's good. You're happy. When they go back down again, you've now got a weekly deposit going in. So if we have more volatility in the markets, doing a smaller weekly deposit, no doubt, going to be very helpful to you. And number 4, the 4th tip that I have for you here, just don't overcommit to your retirement accounts. Again, I get it. The financial advisory industry, we're supposed to scare you into saving more. There's a lot of bad apples out there. But the people that are really trying to help you will tell you not to overcommit. They will offer to help you. So how much do you need to save for retirement? I don't know. I have like a robo-advisor and I used a calculator and it told me how much. Okay, but how much do you need to save for retirement? And however much you need to save is all you should do. Don't let anybody else scare you into indexed universal life policies. You didn't ask for that. You were trying to do retirement investing, right? You just save what you have to save, and what I want to do is actually go through a quick scenario for you so you have an example of some of the things that you should probably know. How much of you have saved already? Let's say you have $10,000 already in a 401k or something, or you just got started with $10,000. Then I want to know, how much do you want to shoot for? Let's say you want to shoot for $50,000 a year in retirement. That's the income that you want to shoot for, okay? Got to have that in your head. This doesn't have to be a fixed number, by the way. Pick anything just to get started. You're not supposed to really know what that number is. You're just trying to get somebody to work some numbers for you and see. How much in other income do you think you're going to have? I'll use $15,000 here, Social Security, whatever you want to call it, right? How much in other money do you expect to have a year? But maybe some of you buy houses, you rent them out and everything like that. How old are you now? Let's say you're 30 years old now. And when do you plan to retire? 67 is a pretty common age that a lot of people choose there, so I'll use that one. What I want you to then do is I want you to get someone to work this out for you and see, well, how much do I actually have to save, right? What's it going to take? And in this case, what it's going to take is $5,049 in the first year. You have to save that much. Now that's for the year. We just said, step number 3, break it down, make it even smaller. What I want you to do is go over the weeks. It comes out to $97 a week. That might seem like a lot to you. If that seems like a lot to you, go back up here and adjust the goal. Don't stress about the number. Go say, well, maybe this number has to be 40,000? What's that come out to be, right? Maybe it's got to be 35,000 and I've got to think about maybe buying some rental property or something. This allows you to start thinking. I love how every customer that comes through the door, they see that number and they either email me back and they go, oh man, I can't do that. And I go, great. I mean, let's work it out, right? Rather than me say, well, then you shouldn't be investing. You'll go, no, let's go back and redo some of these numbers. Can we build a plan? And before you know it, your brain is starting to visualize what retirement's going to look like and what it's going to take to get there. Once you figure that out, stop. Quit stressing about it. Move on. Come back to it every now and then and have me rework it out. Let's do it again. But I don't want you to stress about it. So tip number 1, don't go too heavy on dividends. They're not, I get a bad rap there. People give me a hard time for, banging on dividends or whatever. I'm just saying don't have too much of that. Don't go too heavy just yet. Build the net worth, then go for that passive income. All right, tip number 2 is make sure you're investing aggressively enough, and I probably should add to that, efficiently enough too. Make the most out of the investments that you have there. Number 3 is be small and consistent. Find the number, be small and consistent. And tip number 4 is don't overcommit, right? Know the number, commit to it, go down that path, adjust as you need to, but don't overcommit and stress yourself out. It's just not going to be fun, and investing is supposed to be fun. Well, if you think investing is fun, I hope you'll keep us in mind at Jazz Wealth. Check us out on our website there, but more importantly, maybe you'll come back to our live show that we do. It's called The Closing Beat every day at 5 o'clock Eastern Time, live on our YouTube channel, Jazz Wealth Managers. We cover the stock market, all kinds of good stuff. We're playing a game there as well. I hope you'll join us for that game. Otherwise, have a great rest of your day. Thanks for watching.
Why should you choose Jazz Wealth as your retirement or long-term investing service? Our portfolios are managed by us, not some faceless mutual fund manager. Our private classes will teach you everything about investing and getting your dough straight. Best of all, our fiduciary standard means your best interest comes before ours.